It's been a challenging first half with significant external cost headwinds and supply chain limitations directly leading to lower than expected revenue and reduced year-on-year operating margins despite strong demand. However, we are pleased to say that we have prioritised the delivery of our best-in-class service, which, particularly under the circumstances of global supply chain challenges, has been acknowledged by our customers. We are on track to ship all orders for Christmas. We have also continued to push ahead with a number of strategic initiatives and have generated synergies from the CSS integration. So while external challenges still remain ahead, we are confident we remain well positioned in the longer term.
From a financial standpoint, group revenue in the first half was up 11% year on year to $483.9 million. This reflects particularly strong trading in the first 4 months to July, with sales up 25% on the equivalent prior year period. However, the macroeconomic supply chain challenges relating to freight availability and delayed shipments accelerated in our peak revenue months of August and September, resulting in deliveries to customers being delayed into October and November. As a result, our half-year revenues were lower than expected, but will be recovered in the second half. In addition to the supply chain challenges, cost headwinds, in particular relating to freight, raw materials and labour costs, resulted in lower year-on-year operating margins, with adjusted profit before tax therefore down on the prior year at $19.9 million. As a result of this reduced year-on-year profit performance, our adjusted diluted earnings per share was 13.6 cents. Finally, the board have agreed an interim dividend of 1.25 pence per share in line with our dividend policy.
As with many businesses, we have experienced major external cost inflation across labour, materials and freight, alongside limited availability and extended lead times across all regions. To give some idea of the headwinds faced, sea freight rates have increased by over 500% in some regions. We've also seen very restricted availability of sea containers, port closures in China, as well as a significant port backlog in the United States, all of which extend lead times. In addition, we've seen raw materials incurring double or even triple-digit inflation, with average lead times having increased from 2 months to 5 months for core commodities such as paper and polypropylene. While some flattening of cost inflation was evident in June and July, it significantly increased again from August onwards. When it comes to labour, there have been significant industry-wide staff shortages and higher than usual turnover rates. Lastly, we've seen our mix of sales change, mainly due to a normalisation of demand compared to the COVID lockdown peak demand for some categories such as craft, whilst the availability of other higher margin categories has been sporadic. We have been working hard on mitigating the headwinds as quickly as possible. However, the speed and size of the changes we have seen in such a short period of time have limited our ability to respond in the current year. As a result, our focus now is on what we can do to improve our future positioning, particularly in FY23, where we see opportunities for significant recovery. For example, there have been far-reaching changes made to commercial terms to de-risk all parties going into FY23. In some cases, order planning and commitments are already 1 to 2 months ahead of FY22, and negotiations including agreed parameters to de-risk or eliminate the impact of extreme cost inflation. Alongside this, there is an ongoing emphasis to drive sales of design group brands and continuing growth in higher margin categories. We've really focused on our product offering and customer service, ensuring that we're able to provide a portfolio that reflects our omni-channel presence and the demands of our major customers. In the Americas, this has led to 8% sales growth overall in the first half, albeit with significant delays of shipments in August and September that suppressed growth. We have continued to focus on the consolidation and integration of our US team post the CSS acquisition, which has further been strengthened with the addition of both Chief Commercial Officer and Chief Revenue Officer roles. We were delighted once again to be awarded the Walmart Supplier of the Year for seasonal and celebrations products. In our international business, revenues grew year on year following the decline seen in the prior year due to the impact of COVID-19. The UK business has seen sales of the sustainably focused eco-nature products progressing well, with items selling out in stores. Working with the winning customers in Europe has once again delivered double-digit revenue growth, and in Australia, despite major COVID-related lockdowns, there was a 22% sales growth achieved in H1. As with many businesses, our current focus is managing the supply shortages and inflationary pressures. We also continue to ensure we deliver on our customer service and the quality of our product propositions, which underpin the long-term success of the business. In the second half of the current financial year, we expect to continue to see major cost inflation across all areas, as well as further COVID-19 restrictions in the near term. As a result, we will continue to focus on meeting commitments to customers with the resultant impact of lower operating margins, as previously announced. As we move into the new financial year and beyond, we see the opportunity to recover our margins through the mitigation of a substantial proportion of the cost headwinds, which we do expect to continue into FY23. We also see continued opportunities to drive further synergies throughout the business, through site consolidations and rationalization, including SKU consolidation and efficiency initiatives. We will also have an ongoing emphasis to further enhance the actions we take and our product portfolio to progress our sustainability agenda. Looking further out, we believe that a vision of a business with revenues exceeding $1.5 billion and adjusted EBITDA of $150 million remains achievable through organic growth and discerning M&A opportunities as our industry's premier consolidator. And as such, we are confident our strategy remains the right one in the longer term, and look forward to returning to our strong history of earnings growth as soon as possible.